If everyone, we'll just give everyone a minute to begin and then we'll start. Good morning, everyone, and welcome to our webinar, where today we are going to focus on the Main Street Lending Program and giving you updates about it. Please post your questions in the Q&A only. A recording of this webinar and slides will be posted shortly on our community site, and late in the day, we will email a copy to participants. A little bit about myself. I am the founder and CEO of MultiFunding. I'm an columnist on business lending issues. I'm featured in the Wall Street Journal, the New York Times, and other publications. I've advised the White House, Federal Reserve, and Treasury market on business credit markets. I have a book out called The Growth Dilemma, and I'm a proud EO board member of Philadelphia. Some disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. Now that lawyers are over, let us begin. Today, it seems to me that most business owners and entrepreneurs are understandably in survival instincts. There's a certain herd mentality and everyone is nervous, fearful, and scared. Coronavirus is legitimately a frightening thing, and the economic impact as well as the impact on all of our lives and our families is uncertain. Yet, at the same time, at some point, it is our responsibility as entrepreneurs to start thinking about what is next. Crisis brings opportunity, and opportunity will knock at different doors. And we now must take this time as businesses slowly start to begin to reopen and we recalibrate ourselves to prepare for this battle. This involves strategy. We have to think about how and what we're going to do to tweak our businesses. Maybe for some of us, it will be 5%. For others of us, it will be dramatic. We have to sort through our team and keep our teams motivated and calibrated. And we have to think about our cash. The Main Street Lending Program provides an opportunity for us to think about our cash, and that's what I want to describe to you today. Main Street Lending Program is, in the CARES Act, allocated for $600 billion. It will be in effect until September 30th, 2020. And so there's a relatively short window of time to take advantage of it. And within it, there are 3 facilities, a new, priority, and expanded. And I'm going to do my best to explain each of those to you today. Eligible lenders are U.S. federally insured depository institutions, including banks, savings associations, or credit unions, and bank holding companies, savings and loan holding companies. This is not a program that you can go to a non-bank lender or a fintech lender. It will be different than the PPP. In order to be eligible, your business must be established prior to March 13th, 2020. You have to meet at least one of the following 2 conditions. You have to have less than 15,000 employees or 2019 annual revenue of less than $15 billion. You have to be created and organized in the United States under the laws of the United States and agree not to participate in the primary market credit facility. You can also only participate in the new priority expanded Main Street lending facility. You cannot participate in more than one. And you have to not receive support pursuant to the Coronavirus Economic Stabilization Act of 2020. Eligible business types to participate include partnership, limited liability company, a corporation, an association, a trust, a cooperative, a joint venture with no more than 49% of foreign entities owned by no more than 49% owned by a foreign entity, or a tribal business concern. Some ineligible types include financing companies, companies involved in lending, Passive business, so if you are a landlord and own real estate or a developer, you cannot participate in this program. Private clubs, such as our country club, would not be eligible to participate. And businesses where an associate who is incarcerated or on probation or parole cannot participate. There are affiliation rules here that apply to accounting total revenue and employee count. And while it is not clear in the guidance, we assume that the EBITDA is rolled up for affiliated companies as well. So if you own multiple companies, we believe that the EBITDA will be counted universally in determining your eligibility for the program. So let's start with the new and priority facilities. The loan attributes for the new and priority are, these are secured or unsecured term loans that was determined and negotiated with your lender. There is a 4-year maturity. Principal and interest payments are deferred for 1 year, and unpaid interest will be capitalized, so you'll start recurring that in year 2. The rate will be an adjustable rate of LIBOR on the 1 or 3 month spread, which will be determined by the bank, plus 300 basis points. The minimum loan size is $500,000, and the maximum loan size is $25 million. Prepayment is permitted without penalty, and fees are between 1% and 2% for an origination fee. So how does the new facility work? Essentially, what's really different between the new facility and the priority facility is the priority that the government and the bank have vis-a-vis your other lenders. For a new loan facility, your current lenders have to agree that should the company go bankrupt, they will have equal rights with your current lenders. But the new facility, the new lender does not have to have equal rights or senior rights to your current lenders. I know that's quite a mouthful and hard to understand. And the principal is amortized on 1/3 at the end of the second year, 1/3 at the end of the third year, and 1/3 at maturity of the end of the fourth year. So you will pay nothing during year 1. Month 13 will be interest, month 14 will be interest, month 15 will be interest, and month 24, there will be one balloon payment due of 1/3 of the loan. Let's take an example. A company with $500,000 EBITDA, their not to exceed would be $2 million, or 4 times that. If that company has existing debt of $500,000, their potential new money would be $1.5 million. If you take a company of EBITDA of $500,000, which is row number 3, their not to exceed would be $2 million. They had existing debt of $1.5 million, they could get potential new money of $500,000. When you calculate existing debt, that includes lines of credits that are drawn and both undrawn. For a very baseline new loan scenario, if a company had 0 debt and had $125,000 of EBITDA, they could borrow $500,000 under this facility. Now let's talk about the priority facility, which is a little different. The primary difference here is that the lender, the new lender that will give you this loan, has to have rights that are equal or senior to your current lenders. That is, in today's world, not just in the case of a bankruptcy, and the principal amortization is less. Instead of 1/3 being due at the end of year 2, 15% is due. 15% is due at the end of year 3, and 70% is due at the end of year 4. So also, on these loans, the amount is not to exceed 6 times your EBITDA. So to take the similar companies, in row 1, a company that had $500,000 and $500,000 of existing debt could now get a priority loan facility of $2.5 million. And if you take row 4, where this company had $2 million of existing debt, they could get a priority loan facility of $1 million. And for I'm sorry, the slide should say a priority loan scenario, a company with $83,000 of EBITDA in 2019 and 0 debt could borrow $500,000 under a priority loan. Expanded facilities are really for bigger companies, but I think it's important to explain. These are tag-along rights. They are adjacent to an existing loan. So you would only get an expanded loan facility with your existing lender. They have a 4-year maturity. The rates are the same at LIBOR of 1 or 3 months plus 300 basis points. The principal amortization is the same as the priority facilities. The minimum loan size is $10 million and the maximum loan size is $200 million. And these have a smaller origination fee of 75 to 150 bips. The expanded loan facility, at the time of upsizing, at all times, the upsized tranche is outstanding. The upsized tranche is senior to or pari passu with in terms of priority and security. Eligible borrowers, other loans or debt instruments other than mortgage debt. So let's take an example of row 4. Would be a company with $10 million of EBITDA and $100 million of existing debt. They would be able to get an expanded loan facility of 35% of that, or $35 million. If they had $25 million of existing debt, the 35% of that would be $8.75 million, which would be too small, and they would not be eligible to receive an expanded loan facility. You have to make certain certification and covenants when you get one of these loans. You have to commit to or refrain from repaying the principal balance of or paying any interest on any debt under the, until the eligible loan is repaid in full, unless the debt or interest payment is mandatory and due. You cannot pay down your existing debt. You have to commit not to seek or reduce any of your commercial lines of credit with the eligible lender or any other lender. And you have to certify that you have a reasonable basis to believe that you have the ability to meet its financial obligations for at least the 90 days period. You do not expect to file for bankruptcy during this time period. This loan program is designed to help companies that intend to live to fight another healthy day. If you think your company has a high chance of going insolvent or bankrupt during the next 90 days, this loan program is not for you, and the lender is going to look at that. You must commit that you will follow the compensation stock repurchase and capital distribution restrictions that I will describe in a minute. If you are an S corporation or other tax-through entity that is an eligible borrower, you may make distributions to the extent reasonably required to cover your owner's tax obligations in respect to the entity's earnings. And what does the stock compensation requirements mean? You agree to, up to 12 months after the loan is paid in full, not to repurchase an equity security that is listed on a national securities exchange of the eligible business, but perhaps more importantly and relevant, not to pay dividends or make other capital distributions with respect to the common stock of your business, unless you are an S corp or a tax pass-through like I described before. For those who earn between $425,000 and $3 million in 2019, you agree not to make more than that amount for any time you have the loan or 1 year thereafter. For those who earn more than $3 million, you cannot, let's say as an example, you made $6 million. You can make half of the difference between 3 million and 6 million, so you would be able to make $4.5 million. You commit to make reasonable efforts to retain your employees during the time. What does that mean? You should undertake good faith efforts to maintain payroll and retain employees in light of your capacities, the economic environment, available resources, and the business's need for labor. Borrowers that have already laid off or furloughed workers as a result of the disruption from COVID-19 are eligible to apply for Main Street loans. I think the fundamental difference here is while the Paycheck Protection Program is really designed to save jobs, the Main Street loan program is really designed to save companies. How will EBITDA be calculated? For the Main Street program, the new loan facility and the priority loan facility, the lender will have to use the calculated adjustable EBITDA for the eligible borrower if they've lent to them before, how they've done it historically, or as a baseline, the lender will have to use their previous methodologies for their institution for considering adjusted EBITDA. So that is important. How EBITDA is determined will be subject to the lender's discretion and the lender's individual policies. We believe EBITDA will be considered across affiliated companies as well, so they will look for the EBITDA across your affiliated companies to determine this. How will debt be calculated? How do they determine how much debt you have? Existing, outstanding, and undrawn available debt includes all amounts borrowed under any loan facility, including unsecured or secured loans from any bank, non-bank financial institution, or private lender, as well as any publicly issued bonds or private placement facilities. So there are some questions about what happens if somebody has an asset-based line where it is a formula, they have a high line availability, but it's a formula based on their AR and or their inventory. In these cases, the line amount won't count. It will be how much they could borrow based on their borrowing certificate. How do you choose which one is best for you? Well, let's take an example of a company with $2 million of EBITDA and $5 million of existing debt. Under a new facility, they could get $3 million. Under a priority facility, they could get $7 million. And under an expanded facility, they could get 0. So really, it would be a matter of which one made the most sense for them. How do you think about all this? Financing strategy is really about playing offense and about playing defense. You have to think about both. And so this opportunity, this facility, allows you to prepare for the unexpected and the future that will come. Some case studies. Example number 1 is a company with $3 million line of credit and $1 million is drawn. The line of credit has a personal guarantee. They are planning on getting an MSLP for liquidity. They would rather not personal guarantee the capital required to reestablish the business, and therefore are planning on using the Main Street lending program accordingly. Another example is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They're planning to take a Main Street lending facility to spread the income hit over 4 years instead of 1. Example number 3 is a company that is already being approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use MSLP money to help. Next out, MultiFunding is offering packages to help, and we're certainly available to help anyone who needs it. I know I've covered a lot of information. This is based on a lot of new guidance that came out yesterday. We've done our best to sort through it and make it clear to you. And we would be happy now with the moderator to take any questions in the Q&A and also in the chat. We will take any questions about the Main Street lending program first, and then we will proceed to the PPP or EIDL if anyone has questions on those. Thanks, Hannah.
Thank you, Ami. Do you think it would be better to apply for a Main Street lending loan through a small lender or a large lender? We currently have an account with a large bank and have no success with the PPP.
I think that question really depends if you have any existing senior debt and where it is and what banks will participate in the Main Street lending program. I don't think all banks are going to do this. It won't be nearly as abundant as the PPP.
Do companies need to be rated by an agency to participate in the Main Street program?
No.
If a company received an EIDL or PPP, can they participate in the MSLP?
Yes.
Can you add more explanation with the difference between the new and priority loan options?
Yeah. Really, the priority allows you to get more money. Question is what your existing lenders, if you have existing debt, will agree to in terms of the rights of the new lender with this program. And that's what it comes down to. If you're going to get the priority loan program, the existing lenders have to have more rights. And it really will be a matter of what you can negotiate with them.
Can the first program be used for acquisition or change of ownership transitions? What loan size preference, if any, will be given in underwriting?
So the first question is, there's no guidance anywhere about what you can or can't, it says what you can't do with the money, which is you can't use it to repay old debt. It doesn't say on the flip side of that. So that's the one thing. The second thing is that the loan size is driven by the formulas here. Now, any one particular lender might say they're not particularly, even if they might at their discretion say, oh, I'm not comfortable to give you the max, I'll give you less. And then you have to decide if you're willing to take that or go to another lender.
If you have received funding under the PPP CARES Act, can you still get the MSLP?
Yes, as long as you're in formula.
And does the existing PPP loan affect the debt calculations for this program?
Well, that depends when you apply for it and when you get it. But if you apply for it and you get it and the PPP is still on the books as debt, we're going to assume it counts.
Is there a list of approved lenders for the MSLP?
No,
When will we be able to apply for these programs?
it's not open for business yet, but we hope it will be open very soon. Again, new guidance came out yesterday. There's still some questions about the guidance, although it's a lot clearer than the first set of guidance. So right now, just as I was up all night reading, interpreting this, so will many lenders.
Are there restrictions how the funds are utilized, i.e. payroll, real estate purchase, or acquisition of another company?
You can do whatever you want with it once you have it, as long as you don't use it to repay old debt. But remember that it is a 4-year amortization, and even though there are no payments during the first 12 months, which feel attractive, it could go, you're going to have to pay this off pretty quickly. So you have to think about that when you use it.
Concerning the new and priority loans, can we choose between those, or are they determined by circumstances? One appears to offer 4 times EBITDA and the later 6.
It really depends upon if you have no debt, you might as well take the priority because it gives you more money. If you have existing debt, that really depends upon what can be negotiated with your existing lender, because they have to give up certain rights.
If we have a line of credit and a term loan, does it make sense to pay down the term loan with the line of credit in order to increase our borrowing capability?
It's not clear to me, but I think it won't be allowed if that's in this window. If you had done that 3 months ago, it would be fine, but I don't think that would be allowed to do that today.
Do you expect most community banks to participate as lenders in the MSLP?
No, I don't think, unlike PPP, where thousands upon thousands of banks participated, I think there might be a few hundred banks participating in this program. That's just a hunch.
To clarify, this loan cannot be used to pay off other debt, correct?
Correct.
We have settlement monies due on our balance sheet. This is debt, but not a loan. Is a debt going to be included as part of existing debt?
I'm not sure what you mean by settlement monies, so that would sort of be, want to dig into that a little bit more to answer that question.
While you can't use MSLP for paying down a line of credit, can you use it for payroll and other expenses using new income to pay down your secured line of credit?
You can use it for payroll and other expenses, but I don't think you can pay down your secured line of credit more than you would have to by the minimums contractually allowed while you have this loan. You'd have to pay this loan off first before you do that.
Can you go over the repayment amounts again?
Sure. So for the new loan facility, there's no principal or interest during year 1. Then for months 13 through 24, you pay just interest, and month 24, you pay a third of the principal due, like in a 1/3 balloon payment. Then months 25 to 36 are interest. Month 36 of the next third. Month 37 to 48 are interest, and then it's the next third. Same formula for the other facilities, except payments at year 2 and 3 are 15% of the balance instead of 33% of the balance. And at year 4, it's 70% of the balance.
Can you go over debt, line of credit, and credit cards effect on the loan?
Sure. So any outstanding debt reduces the amount of loan that you can get. So it's driven by your EBITDA. So let's take an example. If you have $300,000 of existing debt and you have EBITDA of $2 million, you would take you have EBITDA of $500,000 and $300,000 worth of existing debt. For a new loan facility, you could get $1.7 million, which would be 4 times the EBITDA minus the 300,000. And for the expanded loan facility, you could get $2.7 million, which would be 6 times the EBITDA minus the $300,000.
Is there an application or list of required documentation out there yet for the MSLP?
No, but we at MultiFunding are working on packaging up clients, and we are preparing them for a comprehensive, quite exhaustive underwriting. This will be much more like applying for a regular loan other than the PPP, which is fairly quick.
Are the PPP funds included even though they are going to be forgiven?
We're assuming at this point they are, but that will really depend if by the time this closes, which probably won't, none of these will probably close till mid-June. If your PPP has already been forgiven at this point, then it won't be counted.
Sounds like I have to be profitable to obtain these loans. Is that correct?
You have to have positive EBITDA in 2019, correct?
This is for we have a settlement monies on behalf of the balance sheet. This settlement is from a lawsuit. So we have settlement monies due on our balance sheet from a lawsuit. Is this debt, but not a loan? Is this debt going to be included as part of our existing debt?
I'm really not sure. I think that would be subject to the interpretation of your lender.
If we are required to pay a % of revenue as a product to its previous owner, is it considered debt that should be factored in?
Please repeat the question, Hannah. I'm sorry.
If we are required to pay a % of revenue of a product to its previous owner, is that considered debt that should be factored in?
I don't think so. That might be up to the interpretation of the bank, but I would argue that it shouldn't.
How many years of positive EBITDA are needed?
Just one.
Concerning the distributions or dividends, if we secured an MSLP and only took $200K in 2019, could I take up to $350K in future years?
Really, the only criteria is for people who took 425 in 2019. So I assume if you took up to 425 in future years, you would be fine.
Fee structure is 1% or 2% of the loan?
It's a minimum of 1%, but the lender has some expenses that they have to incur with the Federal Reserve for an additional %. And we're assuming that most of them are going to pass those on to the borrower as their right to do so.
If the business isn't yet profitable, negative EBITDA, is it ineligible for the Main Street Lending Program?
Correct.
To clarify, this loan cannot be used to pay off other debt.
Correct.
I have a loan with a non-traditional lender and would like to consolidate that debt. Is it possible the MSLP, or do we have an idea of when we'll be able to apply?
Not use an MSLP to consolidate that debt. That is not an eligible use of proceeds. We're hoping that applications for the MSLP will start in the middle of May.
It says multi-draw or a slug, in parentheses, all at once.
Not sure what that means.
Me neither. It is believed that if you apply for the priority loan, that there will be no collateral or personal guarantee.
We don't think there's personal guarantee on any of these loans. The lender does not have to take collateral per se. However, it is rights. The lender does have the right and will put a lien on the company. And so the priority on the lien, the rights of the lien will differ depending on if it's priority or new.
Can you go over the amortization schedule for the new loan facility again after 1 year, et cetera?
Sure, we really need to add this visually, and we will in subsequent presentations. We ran out of time, but so for the first year you pay nothing. Then in the second year you start paying interest only for the first 11 months, and then at month 24, a balloon payment of 1/3 of the loan amount is due. Same thing happens in year 3 and year 4. I think the hope is that by the time that second balloon payment is due, the economy will be doing well, and a lot of this debt will be refinanced or paid off anyway.
Can you take multiple draws, or do you have to take the loan all at once?
You have to take it all at once. You can pay it down in pieces. You have to take it all at once.
When
It's not a line of credit.
When MultiFunding helps a company get an MSLP, who pays?
Oh, we are offering consulting services to borrowers for that, and on a very limited basis.
There will not be any use of funds issued as long as you don't use the existing debt. So won't the lender request use, therefore you don't have to know where the money is going?
I think the lender is going to want to see some forecasts and an idea of what's going to happen to your business, but I don't think any lender is going to require very specifically where the money is going to go.
Looks like we just have one final PPP question. Looking for guidance on the PPP. We will be funded soon, and since we sell tickets to events, are we not likely to have work for a few months or weeks?
So what's the question?
Yeah, please clarify, Debbie. Does the Fed get any of the O fee?
I'm not sure what you mean by O fee.
Yes, please clarify. Origination fee.
The Fed does get some of the origination fee, correct? And the Fed is buying different amounts of this paper from the lender. So depending on the instrument, the Fed will own anywhere from 85 to 95% of the paper. That's why this is really taxpayer money.
How many different service fees are there for MSLP?
There's not really a service fee. It's you pay the interest and you pay the points.
The loan cost is 1% of the amount borrowed, correct?
It's one for the new and priority is 1% to 2% now, depending on if the lender chooses to pass some of their fees they have to pay to the Fed, to the borrower, which is at their discretion. And for the expanded loan facility, it will be between 0.75 and 1.5%.
How will banks determine secure versus unsecure existing debt credit worthiness?
I think that will be all subject to each individual bank and negotiation.
Clarifying the PPP guidance. We must spend our PPP on eligible costs in the 8 weeks after funding, when we then have to lay everyone off again and there will be no events. So basically, guidance on if we won't have work for months, then we have 8 weeks to spend. So guidance around the forgiveness.
Yeah, you have to follow the letter of the law, which is to take care of the next 8 weeks, and then we'll see what happens at that point.
Can you require employees to take PTO during those 8 weeks of the PPP period have not forgiven?
I don't think so.
What do you think is the likelihood of the June 30th deadline for PPP to be extended?
I have no idea.
PPP. When is the earliest we could apply to have our PPP loan forgiven?
You can apply 8 weeks after you got the money. But the lender, at least by the way the rules are written now, has 60 days to process that application.
I have an EIDL question. We have an EIDL application that was submitted at the beginning of April. Our application number begins with a 3. What is the priority given to these applications? Can you shed any light?
If I had any clue, I would share with you, and it's like winning the lottery.
To be clear on facility fees, it currently writes that customers pay 1% and the bank pays the additional 1%. Your comments are assuming that the 1% is being passed to the consumer, hence 1 to 2 range of the fees for borrowing. Is that correct?
Yeah, the bank has the right to pass that on to the consumer or or the business. So we're assuming in many cases they're going to. That's why it's 1% to 2%, because they have the right to, so we're not sure.
If you receive PPP or EIDL from a bank, would you advise to go back to a bank for MSLP or change it up and go somewhere else?
That really depends on your existing debt portfolio, your performance, and what different banks are going to do here. Again, I don't think that 5,000 banks are going to do MSLP. Like in PPP, I think there'll be a few hundred banks from the country doing MSLPs, and that's it.
Can we pay down secured line of credit during the first year when no MSLP payments are due and then start MSLP interest payments?
I don't believe you can. You can only pay down that secured line by the required amounts.
On the PPP, what happens if you don't spend all the money during the 8-week cover period?
That's really subject to guidance that everyone's waiting for.
We just have one final question about describing the process, timeframes, and costs for multi-funding to help a company get MSLP.
We'd rather, we're taking very select clients to help us. And so we'd rather discuss that on a one-to-one basis.
In reference to PPP, how do you believe government is going to handle forgiveness for businesses that choose not to meet payroll numbers and pay back anything not spent at the end of 8 weeks?
I think everyone has to be extremely careful to follow the letter and the intent of the law, which is to bring everyone back and pay them even if they have nothing.
All right, that was their final question, Ami. Thank you so much.
Ladies and gentlemen, thank you very much. I know these are tough and difficult times for everyone, and I hope to speak with you soon. Thank you so much. Take care.